We detected an unusual trade worth $27.5 million on Dell Technologies stock, ticker symbol DELL. In the last hour of the market on the last trading day, November 5th. And what's very unusual about this is that Dell reports earnings in a few weeks on November 26th. And so in this video, we will analyze this unusual option activity to find out how this wealthy investor is trading Dell. Are they bullish and buying or bearish and selling? So that we can also make the same financial decision to make money while the rich are getting richer on Wall Street. Because as we all know, the rich have more access to information, sometimes leaked insider information, including earnings reports, to make better decisions. No wonder the rich get richer. So without further ado, let's dive into the data as usual. As we can see here on the options time and sales tape, in the last hour, on November 5th at 3:35 p.m. at the 11-second mark, these December 20 options were being traded. 2,500 contracts at the 110 strike puts, 165 strike calls, and the 145 strike calls. So what is going on here? Well, let's take a deeper look at the option chain to find out, as well as the historical data, because we need to confirm whether or not these are opening trades. So if we take a look on November 4th, before those trades were made, we can see that for the December 20 options at the 110 strike puts, we have an open interest of 1,900. And at the 145 strike calls, we have an open interest of 1,500. And at the 165 strike calls, we have 700. So if these trades were opening trades, new trades happening, then the open interest should have added and increased. So if we take a look at the new data now for these December 20 options, we can see at the 110 strike puts, we have 6,900 open interest now, which has increased. And also at the 145 strike calls, 5,800 open interest increased. And 165 strike calls, 5,700, another increase. So all three of these options have an increase in open interest. So we know they are all opening trades and not closing trades. And based on our analysis, they were selling the 110 strike puts and buying the 145 strike calls and selling the 165 strike calls. And so when we analyze this trade, you can see here that this is their trade. As the share price goes up, which is represented on the x-axis, this trade becomes more positive profitable. If it goes down, it becomes more negative loss, because this is a long bullish trade, and we can confirm it on the Greeks. We have a positive delta trade. If it was a bearish short trade, it would be a negative delta. Now, keep in mind, they are selling the 110 strike puts, which means they've hedged all the way to this $110 share price. And that is why this blue line is flat. They will not be at much of a loss if it goes down from its current price. So keep that in mind. And by selling these 110 strike puts, selling cash secured puts, they are saying they're willing to own 100 shares at this strike price, which means that 100 shares times the share price of 110, that is $11,000 of buying power required to put on one of these contracts. And since there was a total of 2,500 contracts that they traded, we multiply that out and we get a total trade that required $27.5 million. So keep that in mind. It is quite a significant amount of capital, but it is also earnings. So there is higher risk, and also they are hedged. So they will not be at much of a loss if the stock goes down. So this is a higher risk trade in comparison to the trades that we share on our website. If you want access to lower risk, higher probability of profit trades, then make sure to go to our website where you can gain access to those trades based on stronger data analysis. We'll put a link at the top here. Now, the way we traded this, instead of using a lot of capital to trade each of these contracts, we simply bought the call options at the 145 strike calls. You can see our position here. POS stands for position. Green means buy. And red means sell because we sold the 165 strike calls. And so the trade looks like this. This is a vertical call spread. And when you analyze this trade, you can see here that as the share price goes up, it is also profitable. If it goes down, it becomes a loss. Okay. And you can see that on the Greeks here, this is also a positive delta trade. But keep in mind, it does have a negative theta that is higher risk, and also the positive vega for earnings, because after earnings, volatility will go down. So this is not very conducive to an earnings trade, but it does have a very good risk to reward ratio. You can see here that the risk is the amount that we paid. We see here $403 of debit, and max profit on the blue line that shows up over here is $1,597 per trade. So the risk to reward ratio of 1,597 reward divided by the 403 is a 3.96, which means you could potentially make 396% profit on this trade. So the reward is in our favor. That is one of the ways that we trade. We make sure that the reward is always in our favor, having very good risk to reward ratios when we do trade, because we want to make sure that when we trade, we can gain more in profits than we risk losing, because not all trades will be winners. And that is why diversifying our portfolio with more of these unusual trades can boost our net profits in the long term. If you want to learn more about our strategies, make sure to go to our website. We'll put a link at the top here where you can also gain access to better trade ideas with a higher probability of profit based on stronger data analysis. Let us know in the comments below, what do you think will happen to Dell for earnings? Will it go up or down? As usual, please smash the like button, subscribe if you haven't. Take care and have a wonderful day.